The focus of this video will be on IRA contribution, and so here we have a married couple filing jointly, and what we want to look at is different income levels, and then if they make a contribution to the IRA, and then what part of it, what portion of it will be deductible, and what part of it will be non-deductible. So here we have a married couple, Larry Jones, age 55, Mary Jones, age 52, and married, filing jointly, and their total income for 2023 is $95,000, and they are covered by a retirement plan at work. And according to the IRS, because they are over 50, and then as a couple, they can make a total of a $15,000 contribution to the IRA account for the tax year 2023. And so in 2023, the husband, Larry Jones, he made a $6,500 contribution to his traditional IRA, and Mary Jones also did the same thing. And so the questions are, what part of their contribution to the IRA account is deductible, and then what portion of it will be non-deductible. And this is the chart from the IRS. And so for married filing jointly, if the combined income is less than $116,000, and this is for 2023, and then for 2024, this amount will be higher. And then they can deduct the full amount. And then if the income is somewhere between $116,000 and $136,000, then they can deduct a portion of it. And then if their combined income is above $136,000, and then they cannot deduct any of it. And so, but they can still make the contribution to the IRA account, but it be a non-deductible contribution. And so if we, whenever we make a contribution to a traditional IRA account, and then we want to know how much is deductible and how much is non-deductible, and then we would use what's called the IRA deduction worksheet to figure that out. So now let's go to the worksheet. And this is what the IRA deduction worksheet looks like. And then again, here we make the assumption that this couple, both the husband and the wife, they are participating in a retirement plan, because if they don't, then the numbers will be different. And so the 130 for line 2A, the $136,000 here, this is the upper limit. And so for this couple, if they make more than $136,000, and then their IRA contribution will not be deductible. Line 3 here, this is their income, $95,000, and then we'll make the assumption here that they don't have any adjustments from Schedule 1. And so if they do have adjustment from Schedule 1, like lines 11 through line 19, 23, 25, then we would put that here. And then line 5A and 5B, it'd be $95,000 minus 0, which is $95,000. And then here now for line 6, we'll do the difference here. $136,000 minus $95,000 would be $41,000. And then we looked over here. It says that if this amount here, it is more than $20,000. And then we would put either $6,500 here or $7,500 here, depending on the age. In this case, this couple, both of them, they are more than 50 years of age, and therefore we put $7,500. And so this is the maximum amount that they can contribute to the IRA account. And then line 8 would be the salary, their wages, which is $95,000. And then if they have any and they don't have any other income. And so line 9 will be 0. So line 10 will be 95,000 plus. 0 will be $95,000. So this is what they this is the contribution amount that they made to the IRA, the traditional IRA. And then line 12 here, it says that they can deduct the entire $6,500 because their income is only $95,000. And so for this couple, the husband, he can deduct $6,500, and all of it be deductible, and none of it will be non-deductible. And same thing for the wife. So for a combined, for $6,500 plus $6,500, it'd be $13,000 deductible contribution. And then what they would do is go to Schedule 1 on line 20, and then they would input $13,000. So it would be like this. So this is Schedule 1, and then go to Part 2, and then line 20, IRA deduction, and then they would input $13,000. And then they don't have any other adjustments in here. So it would be a total adjustment of $13,000. And then they would take this amount and go to Form 1040, the Form 1040, and then on line 10, they would input $13,000. Line 9 is the total income, and then the adjustment to the adjusted gross income would be the income minus the deduction here, and then it would reduce the adjusted gross income. And so they deducted $13,000 from their income of $95,000. And now suppose instead of the income of $95,000, what if the income is $130,000? And then how much can they deduct, and how much will be non-deductible contribution? And so again, let's go to the IRA deduction worksheet and input $130,000. So here we're back at the IRA deduction worksheet. So instead of $95,000, now it's $130,000. And again, the upper limit of relating to IRA contribution is $136,000. And this is still below $136,000, so they can deduct part of the IRA contribution. So here we do $136,000, and then here we have $130,000, and then that's what 5A and 5B is. And then 136,000 minus 130,000 be $6,000, and then this number is smaller than it's not more than $20,000, and therefore for line 7A, what we would do is we would take the $6,000 and multiply it by 0.375 for a married couple older with age 50 or more. And so now, if this couple, if their age, both of their age if they under 50, then they would multiply the 6,000 by 0.325. And so in this case, they multiply by 0.375. 6,000 multiplied by 0.375, it'd be 2,250. And then this is the income again, and then no other income. And so down here, 11A, this is the contribution that they made to their IRA account, their IRAs in 2023. And then the worksheet here says that of this $6,500,000, of this $6,500, they can only deduct $2,250 each. And then the rest of it, which is $4,250, this will be non-deductible. And then this will go on Form 8606. And so to summarize this part, the husband can deduct $2,250 out of that $6,500, and then $4,250 will be on Form 8606 as non-deductible contribution. And so, and same thing for the wife, Mary Jones. And so on the Schedule 1, line 20, they would input $4,500, $2,250 for the husband, $2,250 for the wife, and then if they don't have any other adjustment, then on Form 1040, line 10, they would also input $4,500. And then the rest of it, the non-deductible part, 4,250 plus 4,250, which is 8,500, which is non-deductible. And then they would go to Form 8606. And then on line 1, they would input $8,500. And this will let the IRS know that their traditional IRA has $8,500 of a non-deductible contribution in there. And what it means is that when they withdraw this $8,500, and then they don't have to pay taxes on this $8,500. And now, instead of $130,000, what if their income is $150,000? So now let's go back to the IRA deduction worksheet and then put $150,000 and see what happened. And so here we're back at the IRA deduction worksheet. And so again, the upper limit here is $136,000, and then the couple's income is $150,000, and then it's more than $136,000. So what it means is that they cannot deduct any of their IRA contribution. And so since they cannot deduct any part of it, then whatever they put in their IRA, whatever contribution they made to the IRA, all of it will be non-deductible. And then they have to report all of that on Form 8606. And so in this case, the husband makes $6,500 contribution, and then the same thing for the wife, and then all of it is non-deductible. And so since they don't have any deductible contribution, then they don't need to use Schedule 1 if they don't have any other adjustment. And then on Form 8606, line 1, they will input $13,000. And this to let the IRS know that in 2023, they made a $13,000 non-deductible contribution. Now, if this is the first time that the couple is using Form 8606, and then the $13,000 is what's called the traditional IRA basis. So this would be their basis. And so normally, if we make a non-deductible contribution to an IRA account, to the IRA, to the traditional IRA, then we need to keep a list or a record of what year we put in non-deductible, what year we made a non-deductible contribution, and so that way we will know what our traditional IRA basis is. Because we need to know the basis so that when we withdraw the money, then we don't have to pay taxes on it again. And again, since they, and then also the other thing to keep in mind is that since they made this $13,000, which is non-deductible to the IRA, to the traditional IRA, and then one option that they have is they could also move this $13,000 non-deductible contribution to a Roth IRA, and then they don't have to pay any taxes on it because this is non-deductible, meaning that the $13,000 is after-tax money. And so when you move it to a Roth IRA, then you don't have to pay any taxes. And so that's the end of the before we end the video, let's do a summary of this for this couple. So when the income is $95,000, then they made a $13,000 contribution to their traditional IRA, then all of it is deductible. And then if the income is $130,000, and then the $13,000 contribution that they made, only $4,500 is deductible, and then $8,500 will be non-deductible and will be reported on Form 8606. 606. And then if the income is $150,000, and then the $13,000 contribution that they made to their IRA, none of it will be deductible. And then all of it will be non-deductible and be reported on Form 8606. And that's the end of the video.